It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today I've got a lot to cover, a lot of economic information, and I'm going to share one of the best articles I've read in a very long time regarding the war on fossil fuels. We're going to post it on our website, by the way. It's the best read I've seen, probably one of the most balanced ones. It's not a short read, I want to warn you, but one of the most comprehensive I've seen in a while. If you really want to understand a lot of the ramifications of the war on fossil fuels, go to yourpersonalbank.com. It's a Yahoo Finance article. Really, really well done. Again, yourpersonalbank.com. We'll post the link. But before I get to that, I need to really cover some things on interest rates and the Federal Reserve and what's going on with the bank lines of credit and the positive arbitrage. A lot of things have changed. And by the way, this is information I've been sharing, just sent out to my own clients. And in the interest of getting this out to as many people as quickly as possible, I'm sharing this information here on the radio show too. And here's the situation. If you've been listening to the show, you know we've been talking about increasing interest rates. Dividends are highly interest rate sensitive. So as many of the companies have said, they've told us, we're in an increasing interest rate environment. Dividends will be going up. That is all still true. In fact, dividends will be going up. We fully expect them to be going up for the next 3 to 5 years easily, potentially even the next decade. So we're in an increasing dividend environment. We got 6% dividends right now as we speak. That's, like I said, set up correctly. It's guaranteed, insured, tax-free. And that's going to be going up over the next number of years. So that's all good news. But we're in an unprecedented economic uncertain time. I don't think anyone can argue that fact. And so what's happened is all the major insurance companies have decided to be cautious for valid reasons, and they've kept their dividend rates for 2023 the same as what they were in 2022. So what that means is they're paying 6% dividends, okay? But the reason why they're being so cautious, okay, and so before I get to that, and I'll get into the reasons why they're being so cautious, which are pretty obvious. We've talked about on the show using bank lines of credit, and the borrowing costs, of course, have gone up too with the interest rate environment. And the borrowing rates with these fully collateralized loans with the bank lines is prime or prime minus 1%. Now, prime in March of 2022 was 3.25%. Okay, so that's why we were getting borrowing rates in the 3% range, between 3 and 4 actually. And then, of course, as rates have been going up and going up, prime is now at 7%, and most people think that the Federal Reserve is going to raise rates before the end of 2022 again. So that'll put prime at about 7.5%. So what that means is the borrowing rates right now are between 6 and 7%. The dividends are about 6. So the point is, if you are funding the policy and you're earning dividends, right, and then you access funds against it using a bank line of credit, the cost of borrowing is now at or above the dividends that you're earning. So the positive arbitrage that's been there historically for the last 40 plus years, okay, is not there at the moment if you use a bank line of credit. There is a solution though. So please stay close because this is really, really important information. So here's one of the things you can do. You can access funds through a policy loan directly from the insurance company. Think of it as there's a dividend department and there's a loan department. So it's works very much like the bank lines do. The difference is the cost of borrowing now is less than the banks. The current cost of borrowing, depending on the company we're dealing with, is in the 5 to 6%. Well, let me think. 5 to 5.7. Okay, so we got companies that locked in these rates for the next year in the 5% range, low as 5, and are paying 6. So you still get a 1% positive arbitrage with using the policy with your money. So you're not going backwards. In fact, you're still moving forward. Now that's saying a lot considering what's going on these days, and with the cost of borrowing and interest rates and the economy. I mean, you're still moving forward, and compared to the stock market, particularly this year, it's much better to go forward than backwards, right? Now the thing is, you can use these policy loans to pay off the bank lines. There's no cost or fee to do so, And you can do it back and forth, by the way. So I strongly recommend, if you have one of these policies, and whether you're a client of mine or not, contact your bank, find out what the payoff is, and then access the funds from the policy, making sure the loan rates are in that, like I said, in the fives, okay? That's where they should be. And if they're not, contact me at yourpersonalbank.com or 866-268-4422, okay? Because there are some companies that have higher borrowing rates, and those just don't work very well for this concept. So if you've got one of those companies, please, by all means, contact me. Again, that's toll-free 866-268-4422 or yourpersonalbank.com. But the companies we're working with are in the 5% range in the borrowing, and like I said, are paying in the 5.75 to 6% on the dividends. So we still got a little bit of positive arbitrage. We're still moving forward. It's not as good as much as it was previously. But understand, we are in very, should I say, uncharted waters almost. A very economic uncertainty is very high. So my point is this: even though we're getting in a situation that's highly unusual, we're still got positive arbitrage going on. At very worst, break even. So if somebody does use the money from the policy, they're not losing. Okay, now. The best thing you can do now, here's my best advice for anyone. Look, we're in a high interest rate environment. We're in an environment where the economy and asset values and stuff are really uncertain. If you can reduce borrowing for the next year or two, that's probably a really wise choice. And if you can put it into one of these policies and let it sit for a while, guess what? You're going to be earning that 6% dividend. And, 6% insured, guaranteed, and tax-free is not a bad option compared to everything else that's out there. And this is the point I guess I'm wanting to make, and I think is so important. Look, this, I believe, this is when you need to understand something. These insurance companies are some of the biggest and most successful institutional investors out there, and for the longest period of time. In fact, we have several companies that have been paying dividends, which are nothing more than profits. Okay, so in other words, they've been the company, so they've been profitable every single year for 175 consecutive years. I'm going to say that again. I've got more than one company that's been profitable for 175 consecutive years. That means they were profitable through the Great Depression, both world wars, even the Civil War. Okay, that's impressive. All right, and pretty much all of these companies have come out and taken this cautious stance and not raising dividends for the next year, for 2023, and for a number of reasons. Many of them are giving our generational high inflation, stock market volatility, no secret. They're concerned about real estate values, okay, as are a lot of people, and really just high levels of economic uncertainty, right? They're seeing, this is probably some of the strongest evidence I've seen yet from some of the biggest and most successful institutional investors out there that are all, every one of them just about is saying the same thing, that, hey, they're really about the economic climate for 2023. Look, I think you should listen to them. And I would really encourage you, like I said, if you can pull in your horn, so to speak, go more to cash, have some of the money earn some dividends. Why not? Have lots of access and liquidity and positive arbitrage when you access the money to go back into investing in other assets. But it's not a bad idea to diversify and have a bucket here that has guarantees, that's safe and tax-free, and is just going to grow consistently. And like I've said this to many, many people, this is, growing your cash safely right now with this economic environment. This is wise, okay? Wise advice, okay, that I've been given. Growing your cash safely, reducing your debt in these type of economic times, just smart. Increasing your cash available is also smart. Having more cash reserves, just in case, always a wise idea, but particularly in economic uncertainty. And then what this will do is, by having that cash bucket there, by having more cash there and available and growing and having it available, it'll actually strengthen your financial position. And it'll allow you to take advantage of opportunities that are very likely going to become available once the economy improves, once this economic storm, passes by. We're going into a really rough period. Every indication is showing that, and it's not just the insurance companies. I'm seeing expert after expert. I saw an article today talking about CEOs of major companies are more pessimistic about this next year than they have been in a very long time. And of course, they're calling on the same reasons: the economic uncertainty, the high inflation, all those kinds of things. The same things we keep talking about. And look, if you haven't gotten the message, it's time to, wake up and smell the coffee, all right? So if you have one of these policies, like I said, I'm going to encourage you to pay off the bank line because the cost of borrowing from the banks has now gone too high. Now, the beauty of it is we don't expect this to be long-term. Interest rates jack up. They're going to come back. It might be a year or two because it depends on what the Federal Reserve does and how long this lasts. But if they start to back off somewhat, then our positive arbitrage increases again. Or dividends are going to, if the interest rates stay high, dividends are going to go up. And again, our positive arbitrage starts to increase again. So here's the beauty of this. The personal bank concept is going to work if either situation occurs. I mean, I think we can all agree going forward that interest rates are going to go high or stay high, or they're going to go down, right? Again, as I stated earlier, if they continue high or climbing even, we're going to get higher dividends. So I think seeing in 24 and beyond, we'll see higher and higher dividends. That'll be great for dividends, that is. If interest rates slide back a little bit, then we'll see lower borrowing rates from the banks. So either way, we're going to get positive arbitrage again. We still have a little bit of it now, less than historically normal, about 1%, okay? But historically it's 2 to 3%. But again, I fully expect we'll see bigger positive arbitrage again going forward. And by putting this cash away and having it in that safe bucket, consistently growing and having access to the majority of the money day one, it just is going to put you in a better financial cash position. There's no reason to ride the roller coaster if you don't have to, right? That's what I'm trying to get at. And every indication is showing that 2023 is going to be a rough year. I hope it isn't, but it's shaping up to be that way more and more. So I'm just encourage you again, one last time, contact me for more information. 866-268-4422 or yourpersonalbank.com. Now I'm going to encourage you to stay tuned in the next segment because we're going to get into some economic factors and some energy policy, like I mentioned earlier, that I think would be very valuable. So I encourage you to stay tuned and not miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com.